you'll never need more than 5 or 6 words, usually just 2 or 3, of something that will show the IRS a possible future economic benefit to you from this meal. Just a possible future benefit. Something very simple like ask for referrals, got Smith. Ask for referrals, got none. Still in good faith, right? Referral lunch, referral dinner. That's really all you need. Now that this deduction has come back, there is an even better part of it that is something that most of you in real estate were missing. The IRS calls this the Dutch Street Rule. And the way it works is this. Anytime you get together with anyone else who is in the same business you are in, real estate or related business, title, warranty, home inspection, mortgage, State Farm, and you get together with each other in a way that you learn something about it. By the way, I not here personally, I live in Santa Fe. I'm with State Farm and I've been with them for about 25 years. So I just had to give a little shout out because I consider them an excellent company. So all we have to do is if you get together with anyone who is in the same business you are in or a related business, and you discuss business in a way that you learn something about your business, you get to take a deduction for that. Even though there are no clients or prospects around, even though no one's trying to sell anything to anyone, and you just each paid your own way. Everyone in this room, think about this, on a regular basis could create a meal deduction for everyone else in this room. Everyone in your office on a regular basis can create a perfectly appropriate meal deduction on a regular basis for everyone else in this room. Now, how do we audit-proof this one? Very simply. When you record those maximum 5 or 6 words on what you did with each other, make sure that at least one of the words is the word learned. Learn new marketing strategy, learn new disclosure rule, learn a new tax strategy. Just get it recorded within 7 days and you have now just audit-proofed it. So don't just put business discussion, emphasize what you actually learned, and that completely audit-proofs it with the IRS. So, entertainment deduction, gone. Meal deduction is back. And I want to mention one more thing about the meal deduction. If you have an existing business relationship with someone, now, who does that include? It includes people who are your client already, it's people who are already your prospects and you have contact with before you get to a restaurant. And it includes the people that you already know that are referral sources, your friends, your family members. There is an improvement in this aspect of the deduction, and here's what it is. You don't even have to discuss business with them. You can go out to dinner just to maintain that business relationship. It used to be once you go out to dinner with those people, you had to also prospect in good faith. No, with the new people, you still need to do that. But with those with whom you have established relationship, all you need to do is get together with them. We used to laugh in the 60s and 70s. This was called the silent meal deduction. And I'm happy to tell you that the silent meal deduction is back. For some of you, this is a godsend, right? You get together with someone in your family, you can deduct it, you go out to dinner, they begin to speak. No talking, this is the silent meal. So, very nice. So this deduction just got expanded. All right, now, let's go on to Code Section 199A. I believe you are ready. Do you feel ready? Yes. Yeah, you look ready to me. Okay. So let's do the Code Section 199A deduction. Now, I am going to bring up, and again, I'm going to apologize in advance to this side of the room because I know this isn't, I've tilted the board a little, and let's see if I can get this out a little bit further. I believe I can. The wheels aren't moving on that side. I'm sure there's a simple solution for it, but Can you still see it over there? Okay, thank you. All right, so the slide that is up is a slide that we use for a number of professions, but it's more complicated than need be for real estate. Code section 199A, there are a number of ways to qualify for it. And it's driving your accountants mad because it's a very complex code section. I know this because we do trainings of your accountants. And there's a lot of gnashing of teeth over this new code section, and understandably. It is fairly complicated, but you know what? For the most part, not for you who are in real estate. Do you know that the National Association of Realtors marched out, they marched in to the Joint Conference Committee and they lobbied for this deduction. The reason other professions have it is that you lobbied for it. And so you were successful. And you are in a group called the favored group. Now, as soon as you lobbied for it, another group, National Association of Insurance and Financial Advisors, NAFA, copied it and went in, and they got a good result as well. And then the National Association of Realtors did something that no one ever does. You went in and lobbied the IRS. Nobody ever does that. They lobbied the IRS and told them how they'd like to see this interpreted, and you know what? You won everything. NAR got this done perfectly, and as a result, you have the most simple, straightforward way to qualify for this deduction in any profession, and insurance is a close second. So, you are in a group called the favored group. You are the favored ones. Good to know, right? I spoke to the dentist last week, and I don't know if they had done root canals on members of Congress without anesthesia or what the problem was, but they are in the disfavored group. They were not happy. They are going to be writing their congressman. But here's how this works. Now, what I'm going to do is do we have an eraser for this?
You were saying it's in here somewhere on the
Over
desk.
here.
You see? I don't know.
Is this it?
Yeah, that's the one.
This looks like something from a grade B horror movie is what it really looks like. Okay, all right, thank you very much for, oh, it works well. Now I see why they do this. Scientific, right? More surface, right? So I get it now, all right. I take it all back. I didn't mean to, well, I did mean to belittle them, but now I'm sorry that I did it. Okay, so there are two ways, there are two requirements to take this deduction. I know there's stuff on the slide, but I'm going to recommend you just follow what I'm doing here, and that you take notes on it. Now, it's code section 199A. The first thing is proper spelling of code section 199A. There's a shocker, right? And then there are two requirements for taking this deduction. The first is that you have business income. Now, I just read, Murray had me read this article that was about 17 pages on the definition of business income. And I like the CPA who wrote it a lot better before I read it than I did afterwards. Because, let me summarize these 17 pages. The summary is, if you have a business and you have income from that business, you have business income. Oh, okay, thank you very much. So we're all experts on this now, right? We all have business income. It is your commissions. So we all have business income, that is simple. Now, you need to receive this business income in one of three ways. The first way is as a sole proprietor. Now, the reason I am mentioning this first is because Congress mentions it first. And it burns me that we are already discovering that there are accountants telling their clients, I'm sure it's an honest misunderstanding, but there are already accountants telling their clients that they need to form some kind of a pass-through organization to take this deduction, an S corporation or an LLC, and it's not true. The very first group that Congress gave this to, the one mentioned first in the statute, are sole proprietors. If you are a real estate professional and you haven't formed an S corporation, an LLC or anything, you get to take this deduction and you don't have to form anything else to do it. And by the way, if you ever have an accountant or attorney recommend that you incorporate, be sure that you personally understand the reasons for it. It's not enough that your attorney or the CPA allegedly understands the reasons for incorporating. You need to understand them. And I know, and I mean this genuinely, most of us have very good CPAs who are doing their best. But I just want to point out this, that we do see some abuse because if an accountant has a client who now also has an S corporation, they have two clients instead of one. So I'm just saying, make sure that you understand financially, to the dollar, what the benefit is to you from having that business organization. Now, the second way you can receive this income is as an S corporation. So those of you who have S corporations, you get to take this deduction as well. And the third way is as a partnership. Now, what does that mean about LLCs? Well, you are included as well because LLCs have to pick one of those three ways to file their taxes. LLCs are a state creation, they are invisible to the IRS, and when you file your federal taxes, if you don't elect to file as an S corporation or partnership, you're automatically treated as a sole proprietor. So, business income that you receive in one of those three ways. Now, the second requirement is that you have a taxable income that is less than the following amounts. Taxable income less than the following amounts. Now, just a word about taxable income. That is line 41 of your 1040 form. It is the lowest statement of your income. It's after all of the deductions on your Schedule C or your K1, your business return. It's after all of the deductions on, if you itemize on the 1040 form, or if you take the standard deduction, by the way, for 2018, has gone up to $12,000 filing singly, $24,000 filing jointly, up from $6,350 in 2017. So that has improved as well. So all the deductions on your Schedule C or your business return, and all of the deductions on your 1040 form, and when you finally get down to line 41 of your 1044, that is taxable income. And if that taxable income is under, if you are filing singly, if it is under, and these are going to be familiar to you, if it's less than $157,500 filing singly, or less than double that, $315,000 filing jointly, then you have just qualified for this deduction. Now, I apologize, but I'm going to have to use the giant erasing monster to create a little more room on the board. Everyone got this?
1 second.
Okay, so if you qualify, that's pretty straightforward, right? That's real estate, pretty nice, huh? So if you qualify for this deduction, then what do you get to deduct? Well, in most cases, I'm going to qualify this a little bit later, but so what's the deduction going to be? The deduction in most cases is going to be 20% of your taxable income. Now, let's get out of theory and go to an example right away. So let me take an example of someone who has, they're in the state of California, they're filing singly, and for 2018 they had $250,000 in commissions. And remember, this deduction applies to 2018, the taxes you're working on right now. So 20%, so their gross income is $250,000. Now, that's over the 157.5, right? But we don't care yet because that's the gross income. Now, they went out and got our course. They've got an SUV. They've hired their children. They're taking the home office deduction. They set up a Section 105 plan, and they're launching into learning the rest of the 171 deductions. So let's say this year they've got $100,000 worth of deductions. They'll do better next year. Okay, so that means their taxable income, line 41 and 1040 form, since this is all their deductions, is $150,000. Now, that is less than the $157,500, right? So no matter where they started, they now have a taxable income that is below the $157,500. They qualify for this deduction. What's their deduction? Well, 20% of their taxable income. Their taxable income is $150,000. Math majors, what's 20% of $150,000? $30,000. 50% tax rate. How much does that increase our take home? $15,000 every year they qualify for this deduction. This is a big deal. Now, the way to think of this deduction is as a reward. It's like the trifecta. We now have a reward for taking the other 170 deductions because it's the deductions that gets our taxable income down below this. Now, there are three possibilities, three possible situations you could be in for this deduction. One is, you're going, I thought I was gonna have to worry about qualifying for this deduction. I'm fine, I've got a little space. I wish I had a problem qualifying for this. You know, my spouse and I don't have $315,000, whatever it is. So some of you are fine, you're qualifying now, this year, but remember your income is gonna go up. The second category you could be in is that this is kind of touch and go. It depends on your deductions and how you do for the balance of the year. You might be under, you might be over. You're the ones that want to keep a very close eye on this and maybe get some deductions that will make sure that you get under, like, remember, going out and getting an SUV, truck, or van. So that's the second category. And the third category is, look, this is the category I hope you're all in. Your taxable income, either just yours from real estate or yours and your spouse together, is just too high to get qualified for this. There's no way you're gonna get enough deductions to get down and qualify for this. Now, if you're the first category, you're fine, right? You already qualify. If you're the second category, the other 170 deductions just became critically important to you because you're gonna get this reward for them. And whether it gets you this deduction or not, you wanna get on top of those other 170 because you can give yourself a tens of thousands of dollar raise anyway, even without this deduction. So you wanna learn those. And the third category is you're simply too high to qualify. And I'm happy to tell you that because you are in the favored group, that no matter how high your taxable income, let's say yours and your spouse's income is 1.4 million every year, you can still qualify for this deduction. How? I'm just going to tell you what you do, and I'm not going to explain it because I don't want to see the frowns on your faces and the furrowed brows, but I'm happy to go into it in the question and answer. Now, the way you do it is you form an S corporation. Now, you don't have to have an S corporation to take this deduction. And by the way, if you are an S corporation, you're almost certainly going to get a smaller deduction than you would have otherwise. Why? Because you have to subtract the $60,000 you are paying yourself from the amount you multiply by 20%. So that's going to shrink your deduction. But if you are over $315,000 or $315,000 or $157,500, if you are over that, then this is the only way that you might be able to qualify. And how do you do that? You do it by forming an S corporation. And the reason is S corporations are given one additional way. Even though it makes your deduction smaller, you're given a third way to qualify, and that is 50% of the income that you pay yourself. So then the test of how much your taxable income is goes out the window, and you can still take a deduction. Now, I'm not going into detail on that. The important takeaway is that if you're on real estate, you can get this deduction no matter what. That's the point I want to make right now. Now, one final thing, and I'm going to have to erase this again, but the one final thing is there is a phase out of this deduction. In other words, this deduction does not disappear immediately. If you earn over $157,500, but under $207,500, you'll notice that that's a $50,000 phase-out period. You still get part of this deduction. If you're married filing jointly and you are over $315,000 but under $415,000, you still get part of this deduction. That's a $100,000 phase out. So the way it works is if you're 10% over, you get 90% of the deduction. If 70% over or 30% over, you get 70% of the deduction. Half over, you get half of the deduction. And you're not down to zero till you finally hit 207.5 or 415 filing jointly. So that's code section 199A in a nutshell. When we finish, I'm happy to take more questions on it. But that's the basic, simple, straightforward way that you qualify for this deduction as a real estate professional. All right, couple final quick questions on my part, then I'll shift to questions from you. First, how would you like when you go to file your taxes again this next time? Oh, by the way, this is the 199A deduction calculator. We have three Big 8 accounting firms using this now. This automatically calculates your deduction. It calculates it if you have an S corporation or if you don't have an S corporation. If you Google deduction 199A calculator, it's our calculator that you will get because it's become really popular and really useful. Your accountant will want to marry you just for the 199A calculator because it really simplifies life. So that's one more tax analysis tool we have. All right, couple final quick questions. First, how would you like when you go to file your taxes again this next time to have at least another $7,500 in deductions waiting? Now, probably a lot more, but even that would be an increase of $3,000 to $4,000 in our take-home, not just this year, but every year for the rest of your career. Second, what would be the value of knowing that the records that support these deductions were audit-proof? So instead of the annual pit in the stomach, we could trade that for some peace of mind, finally, about the tax side of our real estate business. I think many of you, if you're honest, would admit that if you have peace of mind about the tax side of real estate right now, it's because you're probably not paying attention to it. And my final question is this. Would $7,500 or a lot more worth of audit-proof deductions every year for the rest of your career be worth our normal course tuition once of $1,002? And what if these deductions were guaranteed? Well, they actually are guaranteed, and if you take a final quick look, right in the far right inside panel of your brochure, you'll see on number 4 there, right there at the bottom where it says guarantee. The guarantee is very simple. You probably know research shows we all learn differently. There are not 2 of us in this room that learn in exactly the same way. And because of that, nothing works perfectly for all of us, including our course. We really do understand this. So we make the guarantee as fair as we know how, and the way it works is this. If at any time during the first 3 months you have the course, you decide for any reason at all that you don't like it, it's not working for you personally, it looked at you the wrong way, you don't have to give us any reason, just return the course to us. We know it's marked up, we don't take off for that, we're glad you tried it. Return the course to us, we'll refund your money in full, immediately, no questions asked. It's as straightforward as we know how to make it. Now, I did say we come out and speak. We extend a group professional discount. This last panel was supposed to have been perforated by a company that forgot to do it, that I will not name. They put a little picture of the scissors instead. Well, except to say that it rhymes with Dinkos. So go ahead and give a couple of folds to that last panel. Tear off the last panel, and I will tell you about the discount for those who are interested in enrolling with your professional group. Now, up at the top of that last panel, you'll see a statement. Invest blank and find at least $7,500 in new tax deductions. We've had an outside accounting firm come in now for 16 years. Pardon me, I'm grabbing something out. PricewaterhouseCoopers. Last year, the average course graduate, 3/4 of whom are in your profession, generated over $17,700 in new accurately taken deductions the first year. That was using 23% of the course. So we not only feel very comfortable guaranteeing the $7,500, some measure of how large a resource many of us leave on the table every year with the IRS. Now, I did say when we come out and speak, we extend the group professional discount. If you go back up to the top of that last panel, where everything is added up to the 1,002, take a pen or pencil, cross out the 1,002, put just to the left of it, what is it, SCCAOR? Are those the initials for the association?
Yes.
Yeah, so put just to the left of it, SCCAOR. You need to cut a letter or two out of that, I'm thinking, right? SCCAOR, anything close to that will do fine, but that's going to serve as the discount code. And just below that, 589. That's over $400 savings in your investment. For those who would like